Good day, everyone. You are welcome to Prestige Tutors. Today, we are looking at the general concept of accounting. We will start by looking at the difference between the word bookkeeping and accounting. Bookkeeping is the act of recording the day-to-day financial transactions of any organization. Day-to-day transaction recording, that is bookkeeping. Whereas accounting, on the other hand, is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. Accounting takes over from where bookkeeping stops. It's from what you have recorded, day-to-day transaction you have recorded, that you need to process further by identifying, by measuring, then you communicate the accounting information for the users of accounting information. The users can be internal and they can also be external. When we say internal users, we are talking about the management. We are talking about even employees. When we talk about external users, we are looking at the competitors. We are looking at the creditors. We are looking at the investors. Even the general public, they are external users. They are interested in accounting information for them to be able to make what? Informed judgments or decisions about the economic condition of the organization. You must have been hearing about double entry principle of accounting. What do we mean by double entry principle? This simply is telling us that the whole system of double entry is what? All transactions have one entry in two different accounts. That is the double entry bit we are talking about. All transactions have one debit entry, which is the left side of the account, and one credit entry, which is the right side of the account. For instance, look at what we have. This is the left side, which is the debit end side. Look at the right hand side, which is the credit side. What is the account all about? It can be salary account. So that means anything that has to do with salary, whatever transaction being mentioned, you are going to record it twice. In salary account and in the corresponding account. Now the corresponding account will also have left hand side, which is the debit, and right hand side, which is the credit. For instance, if the salary was paid through cash, this will be the corresponding account, cash account. Now, if salary is receiving, we go to the debit side, which is the left hand side. You record that transaction on the left hand side. For instance, if the transaction 1st January 2021, the organization paid salary of 20,000 naira by cash. Now, payment of salary was made by cash. That means my cash went out to what? To salary. That means salary received the cash that I'm sending out. That means for salary to receive, that means it's coming into salary. Whatever is coming in, the account that is receiving that value, that transaction will be on the left hand side of that account. Salary is receiving the 20,000 naira. Who is the salary receiving the 20,000 naira from? What account is it coming from? It's coming from cash. Now, cash on the other hand gave 20,000 naira out to where? To what account? When? The same dates, 1st January 2021. The cash of 20,000 went out into salary account. Salary is what is going out from cash. This is what we mean by double entry. That means for every transaction is recorded twice. One to the debit side of the receiving account, the second time to the credit side of the account that is given, which is the giver. Invariably, what we are saying is that you debit the receiver, the receiving account, and you credit the giver. That is what double entry is talking about. Everything we are talking about, to debit or to credit, the account we are mentioning. Now, for instance, the salary I mentioned up there and the cash account. These are what? Ledgers. Ledgers are what? The accounts we are talking about. They are the main book of account. In this case, salary is a ledger account. Cash is also a ledger account. So it is used to record total monetary transaction by an account. That is what we use a ledger for. We use it to record transactions. Whatever happens in salary account, whatever whether salary is received or is given out, whatever movement that we have in the salary account is what we call a ledger. Whatever happens to your cash is what we call a ledger. Whether cash comes in or cash goes out, the transaction will be recorded in what? In cash ledger. That means in cash account. So when we will be referring to one account or the other, we are basically saying what? Ledger. Individual ledgers, individual accounts. So they are used interchangeably, whether it's individual ledger or individual account. So when we are talking about types of ledgers, we say we have what we call sales ledger, where we record customers' personal account. Every transaction that has to do with customer personal account, it goes to where? Sales ledger. Now, you have suppliers' personal account. That takes care of what? Purchase ledger. Any transaction you do with your suppliers, all the transaction will go to your purchase ledger. Why all other accounts, whether it's fixed, expense, capital, that will go into what? General ledger. Anyone that is not in the sales ledger or purchase ledger will go into general ledger account. Now, the question is this: how do we record transaction? We have said transaction happen between salary and cash account, for instance. How do we record? How do we know which of these two accounts or these two ledgers do we debit or credit? That takes us to the step to record the transaction. Now, the first step is identify the two accounts involved. For instance, said on the 1st of January 2021, the company paid salary of 20,000 naira by cash. If you are to identify the two accounts involved in this transaction, we have salary and we have cash. Now, the next step is identify the account that is giving and the account that is receiving. That is what? Identify the giver, identify the receiver. Which account is giving, which one is receiving? Now, let's dissect the transaction that happened on the 1st of January that we are looking at. The company paid salary of 20,000 naira per cash. You agree with me, for payment, cash will go out because you stretch cash out to where? Now the cash stretched out goes to salary. You stretch out a cash of 20,000 naira, and salary on the other hand received this 20,000 naira that you have brought out. So that means here, step 2 says identify the account that is giving, the one that is receiving. That means salary is receiving here is the receiver, while cash is the giver, because cash went out and salary received that amount. You have been able to identify this. Then the third step is telling us to what? Debit the receiver. And in this case, debit salary and credit the giver. And in this case, the giver is what? Cash. Please be mindful of this. Once you miss out the second step, once you make a mistake in identifying the giver and the receiver, which is step number 2, the step number 3 will be wrong. That means you do a wrong debit and a wrong credit. Step number 2 is very, very key. You need to be able to identify correctly the giver and the receiver before you can go ahead and say what? Debit the receiver and credit the giver. Please, these 3 steps are very, very important in every transaction you do. They are the backbone of what we call double entry principle. Once you miss out any of these 3 steps, the posting will be wrong. Now, let's look at this illustration that we have. We want to apply the 3 steps to these transactions. Don't forget, you need to know the name of the business, then the date of the transaction, because there's what we call periodicity concept in accounting. We cannot wait for the business, because the business is expected to be in existence unto what foreseeable future. That means it's to be in existence for as long as possible. The business community cannot wait for a business for eternity to determine the performance of the business. Then came up with what we call periodicity concept. That means a particular period is set aside for us to measure the performance of a business. That means date must be attached to every transaction, so that we'll be able to measure, we'll be able to determine the performance or which transaction occur on which date. If you look at it, you have Sam commenced business as a decorator on 1st January. That means the period under consideration is January. Very, very key, because you need to attach date to every transaction you are posting or you are recording. Now let's go. January 1. Sam commenced business by paying 10,000 naira into a business bank account. Sam paid 10,000 naira into the business bank account. Sam is the owner of the business. My entity concept in accounting tells me that the business is different from the owner. So that means whatever Sam is doing, Sam is representing what? The business. Sam, being the owner of the business, is different from the business. Whatever money Sam pays into the business is expected to pay Sam back. That means whatever Sam is giving to the business is a liability to the business that the business must pay Sam back. Because of what we call entity concept, which means Sam, which is the owner, is different from what? The business itself. That means the business can sue and be sued. Now, this 10,000 naira that Sam is paying to the business account, it is not going to his personal account, but to the business account. That means this 10,000 is a liability to the business. The business is expected to pay Sam back. Now, look at this again. This is at the commencement of the business. Sam commenced that business with 10,000. Now, this 10,000 stands as what? As capital to the business. That means Sam is introducing 10,000 to the business as capital. That means the business is expected to pay Sam back that 10,000 because it's a liability to the business. Now, when you get bank account, that means this 10,000 is going into what? Into the bank. The bank is receiving this 10,000 from who? Is receiving it from Sam as a form of what? Capital. That means capital is giving out this 10,000 that bank is receiving. Capital is giving out the 10,000 naira that bank is receiving. Don't forget that though this 10,000 naira came from Sam, but Sam is different from the business. For Sam to have allowed or to have released the 10,000 naira into the business, Sam is saying that though I am different from my business, the business is owing me 10,000 naira that I have introduced into it as capital. The business is expected to pay Sam back the sum of 10,000 naira. Even if this business is to collapse or is to wind up today, Sam is expected to get back his 10,000 naira, giving it to the business. Now, we have been able to identify the two accounts. We have said what? Capital and what? Bank. Now, the second step says identify the receiver and the giver. Capital gave out and bank received. So that means the giver is capital and the receiver is bank. If the giver is the capital, then we need to credit what? The giver, capital. Then we need to do what? Debit the receiver, which is the bank. What that is telling us that credit is on the right hand side of our ledger. Debit is on the left hand side of our ledger. And we have said bank accounts and capital accounts are the two accounts we have in the first transaction. That means we need to open the two accounts. Now take a look at the two accounts that we have identified. Capital accounts, bank accounts. And we have said capital is the giver, while bank is what? The receiver. This is receiver. Now the two accounts, or we can call them what? The two ledgers. Capital account is a ledger, bank account is what? A ledger. The two ledgers have what? They both have debit and credit. The transaction we are referring to that occurred on the 1st of January happened between capital and bank. Capital is giving out to bank. Credit the giver. Come to the right hand side of capital and record that transaction. And go to the left hand side of bank and record that same transaction, referencing the date 1st January. Capital gave bank 10,000 naira. bank receipt on that same date from capital 10,000 naira. This is what we call double entry. Can you see that that single transaction is being recorded twice? One on the credit side, the other one on the debit side. Having recorded the first transaction, let's look at the second transaction, which occurred on the 3rd of January. Bought a motor van on credit from Able for 30,000 naira. The business now also bought a motor van on credit. Now, this motor van is what we call it under the classification of account is referred to as real account. Real accounts are the accounts or the ledgers, those things that we can touch, those things that we can see. We can touch the motor van, we can see the motor van. When we are talking about real accounts, the real account must be what? Recorded. They must be opened. That means we need a motor van account. And now, Able, because we bought from Able on credit, that means we have not paid. Bought a motor van on credit from Able for 30,000 naira. We have not paid Able. The two accounts involved here are what? Motor van and Able account. The motor van we bought, that means we are receiving a motor van is coming into the business. Who gave it out? Able gave it out. That means Able here is the giver, while motor van is the receiver. That means we credit the giver and we debit the receiver. Motor van account, Able account. Debit motor van account for receiving the van and credit Able account for giving out the car. Motor van came in 3rd of January. Who gave us this motor van that came in? Able. How much is the value? 30,000. Able gave out this motor vehicle, which is credit the giver. Credit Able. On the 3rd of January, Able gave this motor van out to who? Motor van account at what? The same value. Look at it. The corresponding account is what we are going to reference. You reference the corresponding account. This means if I go to Able's account on this date, I'm going to see a motor van related transaction of that same date with that same value. It's very, very important. You reference the same date and the amount, because it's possible to have different transactions on a single day, but they will be separated by what the corresponding account and the amount. On the 4th of January, the business also bought decorating tools and equipment on credit from BAP for 6,500. For us to have bought on credit, that means we have not paid. Then the person who sold it to the business, we need to reference the person's name, which is BAP. BAP gave the decorating tools and equipment to the business. That means it's the giver, which we need to what? To credit. What did BAP give us? He gave us what? Equipment tools. That means we receive what? Equipment tools. Then we need to debit it. debit the receiver, and credit the giver. With how much? 6,500 naira. The next transaction, the business on the 8th of January bought paint for 2,500 naira, paying by check. Anywhere you see check, that means what? Bank transaction. Bank transaction. That means we bought something which is what? Purchases. This is purchases. Purchases. Some people may say it's supposed to be paid. No, this is purchases account. If you look at what the business is all about, the business was a decorating business. Now, paint is just a tool, one of the materials we use to decorate. Because you cannot determine at the beginning of the year the color or paint that a customer will request for. So you don't need to go and buy it in bulk. It depends on the job that you have at hand. A customer can walk into a decorator and say, I need to paint my workshop. Then what is the color type? White. Then you go to the market to buy white paint. Another customer may come in. I will not be in need of the white. I will tell you, I need a blue color paint. You go and buy based on demand. So you don't need to store paint and say, okay, you want to keep stock of it or to form your inventory. No. If you look at the decorating tools and equipment, as a decorator, you need this equipment, not for a single job, for probably all the jobs you are going to do. You need your tools and equipment. For the paint depends on the particular job you have at hand. So it's going to form what? Purchases. What you have purchased, what is the means of payment? You paid by what? By check. That means your check went out and you received paint in return. That means you gave what? Your bank check. That means bank is the giver here. Then what did you receive in return? You received your paint, which is your purchasing. You bought paint. Paint came in. Purchases. Then bank check went out. The next transaction says what? 10th of January, we received 4,000 cash from a customer for work done. Now, we have done a particular work, a particular task has been performed for a customer. The customer has to give us value, pay us in return. Now, the work you have done, don't forget this person is a decorator. That means he has rendered what? A service to this person who is not dealing in a tangible good. This is a decorator. It's not a tangible goods that is selling. That means he has rendered the service, which is what? Sales to the person. That's for the work done. A service has been rendered, which is what? Sales. For instance, when you walk into a salon, a barber salon, I want to have my hair cut. The number of haircuts in a particular day amount to the total number of sales made that particular day. So for the haircut, for the work done, is what? It says. For the service done, it says. Now, for your sales, you have received what? Cash in return. That means cash is coming in. You are receiving what? Cash. So once you receive cash, you open a cash account and you open what? Sales account. Sales has gone out, which is the giver. You are giving your sales. Credit your what? Sales account. And you debit what? The means of payment. You receive cash. Cash is coming in. Receiver. Debit cash. That means you go to the debit side, the left hand side of your cash account, and record the transaction, referencing the date and the corresponding account, which is the sales account. You do likewise for the sales account. Record that transaction on the right hand side, which is the credit side, referencing the date of the transaction, January 10, and referencing the corresponding account, which is what? Cash. Now, let's keep the transaction that happened on the 12th and let's go to the 14th of January. The business issued an invoice to a customer, call, for 7,000 naira for work done. You issued an invoice. That means you have performed what? A service to this customer. Now, the person has not paid. That's why we are giving an invoice, which is the demand for payment. Now, look at 10th of January. For the same service rendered, we receive 4,000 naira cash immediately. But call, which is the customer, has not paid for this service. That's why we are not issuing a receipt, but we are issuing what? An invoice, to show that he's still owing us for the same service done. Call has received value. Sales has gone out. We have given sales. We are giving our service. Sales is a giver. Then we credit sales. Who received this? Now, on the 10th of January, we said cash received. But here, we are not going to reference cash because he has not paid. That's why we are giving you the invoice. What is the invoice value? 7,005. Then the person that received is what? Call. We need to bring in call account. Call in this case has now become what? A debtor. Someone who is owing you. Someone who has not paid. Call has now become a debtor for the receiving service on credit, because he has also received it on credit. He has not paid. But that does not mean sales has not gone out. We have rendered the service, sales has already gone, it has already been consummated. Just that the customer has not paid. This is now a credit sales. Who received that service, that sales from us? Call. That means we debit what? Call account. We open call account because we don't have it earlier. We open call account. Go to the left hand side of call account. Record the transaction, referencing the date of the transaction and the corresponding account, which is what? Sales. We have opened the sales account earlier. You don't need to duplicate sales account. Use the same sales account you have opened on the 10th of January. Record the same transaction on the credit side, referencing 14th of January and the corresponding account, which is what? Who received this service? Call. How much? 7,500 naira. The next transaction. The business returned some of the decorating tools back to back. What is the value of the decorating tools returned? 800 naira. Don't forget that we bought these decorating tools on credit earlier. We bought it on credit earlier from BAP. We have not paid. Now we are now returning part of the decorating tools we bought. Now, this transaction on the 18th compared to the transaction on the 4th. Now there's now a change of role. VAP gave out this transaction earlier. We said VAP is what? A giver. We now credited VAP account. In this case, VAP is now what? Changing role. Is now what? Receiving some of these equipment. That means it's now a receiver. They will do what? We debit it. That means this transaction will be recorded on the debit side of VAP. We record it on the debit side, referencing the date of transaction and the corresponding account, decorating tools and equipment. At this point, decorating tools is now what? A giver. And what do we do to it? We credit it with the value 800 naira. So whether the transaction is going to be on your debit side or your credit side, it depends on the role you are playing. A giver now can be a receiver tomorrow. VAP was a giver on the 4th, now is a receiver on the 18th. The role has changed. January 23rd, something significant happened. Sam took 500 naira from the cash to buy a birthday present for his son. What do we call that in accounting? Let me explain this. When Sam introduced 10,000 naira, he paid 10,000 naira into the business account. We said the business is owing him what? The 10,000 naira he introduced as what? As capital, which is a liability to the business. Now, he's not taking 500 naira from the business for what? Present. This is not what? Non-business what? Transaction. This transaction is not business related. Because this is for what? For his son, it's private transaction. And the entity concept says the business is different from the owner. Owner and what? And the business. To have used this money for his son's birthday, and that transaction is not business related, he is going to impart on his what? On his capital. This transaction in accounting is called what? Drawings. Drawings. That means he drew money from the business for personal use. This transaction cannot be classified as business or expenses. That means he's now reducing the amount that the business is owing him. The business was owing 10,000. He has now taken 500 naira from the business for personal transaction. He's going to impart on his capital. After the 23rd of January, Sam cannot tell the business that I have 10,000 in the business. It will be what? 10,000 take away what? The 500 that he has used for what? Non-business related transaction, which is what? Drawings. At the end of the 23rd, the total capital he has in the business will be 10,000 less 500. That will be 9,500. Please, when you draw money from the business for personal use, in accounting we call it drawings. It's going to affect the capital of the owner. But if the money was used for business, it's going to be classified as the business expenses. But he said what? For his son's birthday. That is drawings. Now, this cash went out because cash was taken out to buy what? This birthday present. Birthday present came in while cash went out. So what do? The cash is what? The giver. He gave you 500 naira, which means you credit it. What do you receive? Which is the drawings. Drawing received that amount. Drawing what? Is the receiver. We are not going to say birthday present because we don't know the birthday present and we don't have any ledger called birthday present. But this transaction is what? Called drawings in accounting. So it's going to affect drawings and your cash account. Finally, let's look at what happened on the 28th. Call paid 2005 by check towards his bill. Who is Call? Have you recorded anything for Call? Look at this date. We invoice Call for the service done. I will say this is what? Says and Call. Call was owing us because they have not paid. That's why we gave an invoice. Call here was playing a receiver, while sales was a giver. But look at the 28th of January. Call paid 2005 by what? Check. That means Call is now parting with money. Call parted with 2005 and we receive what? The 2005 by what? It's not cash transaction, it's what? Check. This is what? Bank account, which we have opened earlier. So at this time, we are now what? Receiving what? Bank is now receiving. It's our receiver. That means what? We debit. The money bank received, the 2,500 naira value received by bank came from who? Came from Call. Call is now what? The giver. Credit Call. And debit bank account. Finally, on double entry rules or principle, let's just summarize the rule of this double entry. Debit the receiving account. Irrespective of the receiver, debit it and credit the giver account. Don't forget, the receiver today can be a giver tomorrow, and the giver today can be a receiver tomorrow. It depends on the role that you are playing at a particular point in time. Remember what we solved about Call. When Call received the service, we debited Call for receiving the service. Call is now paying money for the service he received on credit earlier. Call that was a receiver now turned to be what? A giver. So whoever is receiving today can be a giver tomorrow. It depends on the role you are playing that will determine whether the transaction is going to be on your debit side, which is your left hand side, or on credit side, which is your right hand side. Thank you for your time. Till we come again, this is Prestige Tutors. Don't forget, we are going to upload video on ledger, on trial balance, then final account, which is P&L balance sheet. Please, if you have not subscribed to our YouTube channel, please click the subscribe button so that you get notifications anytime we post video. Prestige Tutors, your partner in progress in this MBA program. Thank you for your time.